Very good afternoon. On to your markets now. Asian shares nosedive today. This after Wall Street saw a share meltdown related to Trump's trade tariff policies, with Hong Kong stocks the hardest hit. The Nikkei share average fell by 7.83%. The Hang Seng Index plunged by 13.22%, while the Shanghai Composite Index lost 7.34%. US markets continue to be battered as investors sold off the market, with all three of the major indexes falling well over 5% on the day. The Nasdaq fell so much that it's now said to have entered bear market territory, which speaks to it having fallen by over 20% since its last peak. The magnificent 7 stocks, which include Nvidia, Apple and Amazon, are said to have collectively lost over $1.5 trillion in market value over the past week alone. Pension funds are tied up in these investments as well as discretionary investments. Investors' wealth has been seriously eroded in a short space of time. We only saw losses of these proportions back in the global financial crisis time of 2008 and more recently the COVID pandemic. The Dow Jones Industrial Average declined by 5.47%. The S&P 500 plunged by 5.97%, let's just call it 6%, while the Nasdaq Composite Index tumbled by 5.83%. All right, looking at the all-share index, we see that is falling by 0.25% currently, trading at 81,366 index points. The rand is trading at 19.27 against the US dollar, 21.16 vis-a-vis the euro, and 24.79 against the British pound. On the commodities front, we see that gold is trading at $3,029 an ounce, platinum at $923 an ounce, and Brent crude oil is down quite substantially, trading at $63.75 a barrel. Let's get into the market conversation with James Turp. He's from Sanlam Investments, the head of fixed income investment strategy and portfolio. Thank you very much for joining us, James. So it looks as though markets are going to continue selling off because if we recall what happened with the global financial crisis, even with COVID, when these reactions took place on the market, people were stepping in to actually, stop what was happening. But there's no intervention. It looks like Donald Trump has rolled the dice and we just have to live with it.
Thanks for having me, Nompu. It certainly feels like that now. I mean, the end of last week was painful enough for global markets. And coming in this morning, as you say, looking at the Hang Seng Index down double digits, and our market's really starting off poorly as well. And that's it. So you're looking at what's going to be the solution, who's going to save markets at this point. As you say, in COVID, when our bond market was under severe selling stress, our central bank did step in to provide liquidity, and just that small act led to stability. And we saw similar acts from global central banks at that time. Where we are at the moment is a peculiar situation. Ultimately, it's one country's foreign policy decisions creating ripples across the world. And what could be a likely solution? Well, there's two that initially spring to mind. One is that the type of negotiation tactics that we've seen from the US president could result in walking back some of the severity of those tariffs, and that it is resolved that way. I'm not sure how big a probability that one would be. The other one, and perhaps more likely, is what we're seeing being priced into short-term interest rate markets. In other words, we're seeing the likelihood of interest rate cuts being deployed as the ultimate pressure valve for what is building up weekly in the markets at the moment. We're seeing it in the US curve. We're seeing the bond curve steepen as the short end starts to discount monetary policy easing. And we're doing the same here, albeit to a lesser extent. We're now closer to factoring in 2 interest rate cuts here in South Africa with the first one coming next month in May at the May MPC. These things are fluid in the market, so that's not something that is cast in stone, of course. But if you look at what's being factored in the US, they're now talking a full % of interest rate cuts over there coming through. And it would be hard to ignore that for our central bank too. So that's why we're kind of mirroring that increased chance of rate cuts here.
Yeah.
It's really difficult at the moment, Nampu.
Yeah, very difficult indeed. I see the volatility index, also known as the VIX. It's said to have gone up by nearly 90% in the last number of sessions. What's your reading of that? What does that actually mean? Especially because the scenarios that you painted out, we don't know if they're going to actually actuate. We still have a while before we see any movements from central banks unless they have emergency meetings. So what happens in the interim? What's your reading of this VIX?
So it's a good one to ask, Nampu, because the VIX is this index that ultimately talks to volatility, and it spikes normally ahead of crises. So you would have seen it spike as COVID picture was developing, as the global financial crisis was developing. You saw this VIX as a measure of uncertainty almost increase. And we're seeing it, as you correctly say, it happened and was starting moving into this, what they've called Liberation Day, this negotiation, or this putting tariffs on foreign currencies by the US. And there's other indices you can look at, and that's uncertainty indexes, which are also at highs at the moment. There's a MOVE index that talks about fixed income markets as well. All of these elevated at the moment. They are good, I guess, indicators of uncertainty, and they can be used to sort of put that on a chart and see how they correlate to these risk events. As they decline, you'll normally find that the markets will have retraced before they decline often, and that in turn leads to less uncertainty. So for a recovery, less of a leading indicator, I've found. We are seeing our markets reverse some of the initial weakness as we start to digest this possibility of monetary policy easing at the moment. But it is good to keep one eye or both eyes on all sorts of indicators at the moment because of all this complete uncertainty around at the moment.
Absolutely. James, we've run out of time, but thank you very much, as always, for your insights. As James does mention, with our local all-share index, that has recovered somewhat, still in negative territory. It did dip below the 80,000 point mark, but is now trading above 81,000 points, but still negative territory right across the globe. US futures show that the markets there are likely to open in negative territory after two awful sessions on Thursday and Friday. As I mentioned, just the Magnificent Seven losing $1.5 trillion worth of market capitalization. Well, after a short break, Juliet will have more news for you.